Imagine it is March 14th, 2023. You are a 44-year-old regional sales manager living in Columbus, Ohio. You have spent the last 11 years working out of a glass tower downtown, commuting in each morning with a coffee in one hand and a key card in the other. Your company leases 4 floors of that building. You have a mortgage on a modest house in the suburbs. You have a 401k that your financial advisor told you last year is well diversified. You have a pension through your employer. You feel, by any reasonable measure, stable. You feel like someone who did everything right. Your building owner just refinanced the tower 3 years ago at record low interest rates. The loan comes due in 18 months. The bank that holds that loan is sitting on a portfolio of similar loans across a dozen American cities. None of this is visible to you. None of this touches your morning routine. You park, you badge in, you sit at your desk. The lights are on, the elevator works, everything looks fine. If you have ever wondered why financial crises always seem to come from places nobody was watching, stay with me. What you are about to hear is not a theory, it is a pattern. It has repeated across 6 continents and more than a century of economic history. It has toppled banks that were considered unshakable. It has wiped out the savings of people who never made a single bad decision. And the mechanism at the center of it all is not exotic. It is a building, a parking garage, an office tower, a shopping mall. Commercial real estate, the kind of property most people never think about because they do not live in it, has been at the heart of some of the most devastating financial collapses in modern history. And right now, in the mid-2020s, the conditions that have preceded every one of those collapses are forming again. This video will show you exactly how it happens, and more importantly, it will show you that it has happened before, many times, in ways that should have been obvious, in ways that nobody wanted to see until it was too late. Before we go further, there is something important to understand. Commercial real estate, office buildings, shopping centers, hotels, warehouses, apartment complexes owned by investors, is not like your home. You do not buy it with a 30-year mortgage and slowly pay it down over decades. The way it is typically financed is fundamentally different, and that difference is the first domino in every collapse this video will cover. Most commercial properties are financed using what are called balloon loans. A balloon loan means you pay relatively small amounts for 5, 7, or 10 years, and then, at the end of that period, the entire remaining balance, the balloon, comes due all at once. The assumption baked into the system is that when the balloon comes due, the property will have gone up in value, interest rates will still be reasonable, and you will simply refinance. You will take out a new loan, start the cycle again, and nobody gets hurt. This works beautifully when property values are rising and interest rates are low. It becomes catastrophic when either of those two conditions reverses. Think of it like musical chairs. While the music is playing, everyone finds a seat. The moment the music stops, there are not enough seats. And in commercial real estate, when the music stops, it does not just hurt the person left standing, it shakes the entire floor. Banks hold enormous quantities of commercial real estate loans. In the United States alone, commercial real estate debt reached approximately $5.8 trillion by 2023. A significant portion of that is held not by the largest Wall Street banks, but by regional and community banks. These are the same banks that serve small businesses, that hold local deposits, that underpin the everyday financial life of cities and towns across the country. When commercial real estate loans go bad, these are the banks that feel it first. And when those banks feel it, ordinary people feel it too, even if they never borrowed a dollar to buy an office building in their lives. This brings us directly to the first case study, and it is one that most people in the United States have either forgotten or never fully understood. The year is 1990. The place is New England, specifically the commercial corridors of Boston, Hartford, and Providence. Throughout the 1980s, developers and banks across New England had gone on a construction and lending spree. Office buildings, retail centers, and mixed-use developments had been financed aggressively during a period of economic expansion and relatively easy credit. By the late 1980s, New England had one of the highest concentrations of commercial real estate debt relative to regional bank assets anywhere in the country. Banks, like Bank of New England, which at its peak held over $20 billion in assets, had loaded their portfolios with commercial real estate loans. The assumption, as always, was that values would continue to rise, that office space would remain in demand, and that refinancing would be straightforward when the time came. Then the economy cooled. The commercial real estate market in New England began to soften in 1989. Vacancy rates climbed, property values fell. Developers who had borrowed against the expected future value of their buildings found that the future had not arrived. When balloon payments came due on their loans, the properties they had pledged as collateral were now worth less than what they owed. They could not refinance because no bank would lend them the full amount they needed. They could not sell quickly enough to cover the debt. They defaulted. Bank of New England, having extended billions of dollars in commercial real estate loans, found itself sitting on a mountain of non-performing assets. Non-performing means the borrowers had stopped making payments. By early 1991, Bank of New England was insolvent, meaning it owed more than it owned. On January 6, 1991, federal regulators seized the bank in the middle of the night. It was, at that time, the third largest bank failure in American history. Depositors in Massachusetts, Connecticut, and Maine woke up that morning to the news that their bank no longer existed. The FDIC, the government agency that insures bank deposits, stepped in to protect most depositors. But the ripple effects were severe. Credit tightened across the region. Small businesses that had nothing to do with commercial real estate suddenly found their loan applications rejected. A regional credit crisis had been triggered not by consumer recklessness or stock market speculation, but by empty office buildings and balloon loans that could not be rolled over. The rot was in the beams. The surface looked fine, right up until the moment it did not. Here is something I want you to think about before we go further. If a bank that was considered rock solid, a bank with $20 billion in assets, could be brought down in roughly 18 months by falling commercial property values, what does that suggest about what happens when commercial property values fall in many cities at the same time? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. The second case study takes us to Japan, and this is where the scale becomes almost incomprehensible. In the 1980s, Japan experienced one of the greatest asset price bubbles in modern history. Japanese real estate, both residential and commercial, inflated to levels that defied rational explanation. At the peak of the bubble in 1989, the land beneath the Imperial Palace in Tokyo was estimated to be worth more than all of the real estate in the entire state of California. Commercial real estate in central Tokyo was priced as though Japan's economic expansion would last forever. Banks lent against these valuations enthusiastically. Japanese financial institutions were encouraged by a regulatory environment and a cultural expectation of perpetual growth. They extended loans to corporations, developers, and real estate investors that were secured by land and buildings valued at bubble-era prices. Then, in 1990, the Bank of Japan raised interest rates to cool the overheating economy. What happened next is a case study in how quickly a credit-fueled real estate market can unravel. Property values began to fall. Not crash, not at first, just fall. But in a system built on the assumption that values only go up, even a modest decline was catastrophic. Corporations that had pledged their land and buildings as collateral for loans suddenly found that the collateral was worth less than the loan. Banks that had extended credit based on inflated valuations found themselves holding loans that could not be repaid and collateral that could not cover the outstanding balance. Japanese banks entered what economists later called a period of zombie lending. They kept rolling over bad loans to avoid declaring them as losses. Zombie means technically alive but effectively dead, propped up by accounting decisions rather than real economic health. This continued for years. The Nikkei stock index, which had peaked at nearly 39,000 points in December 1989, fell to below 15,000 by 1992 and continued falling for years after that. Commercial real estate values in major Japanese cities fell by 80% over the following decade. Not 8%, not 18%, 80%. Ordinary Japanese citizens, many of whom had taken out mortgages on modest homes at the peak of the bubble, found themselves in a situation called negative equity. The economic stagnation that followed became known as Japan's lost decade, though it eventually stretched into a lost generation. GDP growth flatlined, wages stagnated. The country that had seemed poised to overtake the United States as the world's dominant economic power spent the 1990s in slow, grinding decline. And at the center of it all were the banks, paralyzed by commercial real estate losses they could not acknowledge, unable to lend, unable to clear their balance sheets. The chair could not find the floor because the floor itself had disappeared. This leads to the second part of this story, and to a country that most people associate with something else entirely. Sweden in 1990. It is a smaller, more tightly regulated economy with a strong social safety net, considered one of the most well-governed countries in the world. The answer, historically, is rarely the people at the very top of the financial chain. Large institutional investors who hold commercial real estate often have diversified portfolios. They can absorb losses. They have legal and financial structures designed to limit their personal exposure. The developers who built the overleveraged buildings often walk away from the loans through corporate bankruptcy. They are protected by the legal separation between their personal assets and the assets of the development company. The executives of the failed banks often leave with their prior compensation intact. This is true even when the banks they led have been seized by regulators. The people who pay the real price are several steps removed from the original transaction. Consider what happened to small business owners in New England after Bank of New England collapsed in 1991. A restaurant owner in Hartford, Connecticut, who had nothing to do with commercial real estate, found that her line of credit had been frozen. This was the flexible borrowing facility she used to manage cash flow between busy and slow seasons. Not because she had done anything wrong, not because her business was failing, but because the bank that provided her credit had itself been seized or was struggling under the weight of bad real estate loans. The bank was in no position to extend new credit to anyone. She had to cut staff. She had to reduce hours. She eventually had to close. Multiply that story by thousands of small businesses across the region, and you begin to understand the real human cost. Now, consider Japanese workers in the 1990s. Japan's lost decade was not just an abstraction. It was millions of young people entering a job market that had essentially frozen. Companies that were technically alive but economically dead, the zombie companies kept on life support by zombie banks, could not hire, could not expand, could not innovate. An entire generation of Japanese graduates entered the workforce during this period. Many never recovered the career trajectories they would have had in normal times. They became known as the lost generation, not because of anything they did, but because they came of age at the exact moment the commercial real estate collapse was working its way through the system. In Sweden, the impact was somewhat more compressed, but still severe. When unemployment jumped from 2 to nearly 9% in roughly 2 years, it was not Swedish bankers who suffered most. It was construction workers, retail employees, service industry workers, people whose livelihoods were indirectly connected. They were connected to a commercial real estate market they had never invested in. The floor gave way, but they were standing on a floor above that floor, and they fell too. At this point, the pattern becomes impossible to ignore, and it raises a question that requires great care to answer historically. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. The historical record is clear on one point. The people who navigate these episodes most successfully are not necessarily the wealthiest. They are not necessarily the most sophisticated investors. They are the people who understood the mechanism early enough. They were able to adjust their exposure, meaning the degree to which they were vulnerable to the collapse. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what does the historical record show about the people who came through these episodes in better shape? There are several consistent patterns, and it is important to be clear that describing these patterns is not financial advice. It is historical observation. The first pattern is this. The people who suffered least were those who had reduced credit dependence. They reduced dependence on credit lines and variable rate debt before the credit contraction hit. In New England in the early 1990s, business owners who had maintained strong cash reserves were better positioned. Those who had locked in fixed-rate financing before rates rose were far better positioned to survive the credit freeze. Those who were dependent on rolling over short-term loans or flexible credit facilities found themselves suddenly cut off. They worked on the assumption that credit would always be available. The lesson from the record is not that debt is always dangerous. It is that debt with uncertain future terms carries a specific and underappreciated risk during periods of financial stress. Debt that must be refinanced, that floats with interest rates, or depends on bank willingness to lend, carries risk. The second pattern is geographic and vocational diversification. In Japan, the businesses and individuals who had the most options were those who were not concentrated in a single industry. They were not in a single employer or a single city most exposed to the deflating real estate market. Rigid concentration in the most affected sectors offered no flexibility. Those with more varied income sources retained more choices. Skills transferable across industries and savings not entirely locked into declining assets provided options. The third pattern is perhaps the most counterintuitive. The people who survived these periods most psychologically intact had already accepted the possibility. They accepted that things could get worse before they got better. They were not pessimists by nature or paralyzed by fear. But they had genuinely internalized that financial systems are cyclical, and stability is not the normal state of affairs. They were not surprised when the tide went out. They had already been thinking about what the beach looked like without water. This brings us back to Columbus, Ohio, back to the 44-year-old sales manager who parks his car in the garage downtown. He badges in and sits at his desk, back to the building whose owner refinanced 3 years ago at record low rates. A balloon payment is coming due in 18 months. What happens to him? In the historical pattern, the answer depends almost entirely on what happens at the institutional level above and around him. If his company is forced to relocate because his building's owner cannot refinance and the bank forecloses, he faces disruption. If his employer, facing its own credit challenges, begins to reduce headcount to preserve cash, he faces something worse. If the regional bank that holds his company's accounts freezes credit, the downstream effects reach him in ways he will struggle to trace. He will not read a news story that says the commercial real estate collapse caused his layoff. The chain of causation will be obscured. The historian James Grant observed that financial crises are always obvious in retrospect, and almost never obvious in prospect. The mechanism was there to see in New England, Japan, Sweden, and America. The data existed, and valuations were stretched, or the debt was piling up. The assumptions were becoming increasingly detached from reality, but the music was still playing. As long as the music is playing, very few people are willing to stop dancing long enough to notice the chairs being removed. By 2023 and 2024, the commercial real estate market in the United States was showing each of the early warning signals. Office vacancy rates in major American cities had climbed to multi-decade highs, driven by the lasting effects of remote work. Vacancy rate means the percentage of space that is empty. In some cities, downtown office vacancy rates were exceeding 20%. Levels not seen since the early 1990s preceded the Bank of New England collapse. At the same time, interest rates had risen dramatically. The Federal Reserve had raised its benchmark interest rate from near zero to above 5% in roughly 18 months. Balloon loans refinanced at 2 and 3% were coming due. Refinancing them at 6, 7, or 8% was mathematically impossible. You cannot service a loan at double the interest rate when your income has declined. Over $1 trillion is coming due. The regional banks holding much of that debt were more exposed relative to their capital than the banks that failed in 1991. The echoes are loud. This is historical and educational analysis. It is not financial advice. Every individual situation is different. The future is uncertain, and history rhymes but does not repeat precisely. The people and institutions involved today are different. Policy responses may differ. Interventions may come in different forms. What history offers is not a script for the future. It is a grammar. A set of recurring patterns allows a careful observer to read the present moment with more clarity. Consult a professional. What this channel offers is context, not counsel. This video is not for everyone. Most people will scroll past the headlines. But if one person in your life needs to hear this, share it with them. Subscribe for more clarity. I will see you in the next one.